In the evolving digital landscape of 2026, the boardroom has transitioned from a site of debate about physical assets to a crucible for quantifying the power of intangibles. As market value soars ahead of book value, executives face a critical question. How can the invisible engines of growth, data, authority, and digital brand equity be rendered visible, measurable, and enduring in corporate financial strategy? Scene 1 opens with the concept of data equity, a term that redefines how organizations perceive and value their relationships with consumers. In post-cookie commerce, first-party data is gold. The database is no longer a static directory, it is a dynamic financial instrument. Data-derived cash flow becomes a new standard where behavioral insights fuel predictive ROI models. Firms leveraging these refined datasets witness exceptional returns, some reporting up to 8 times greater efficiency in ad spend. As machine learning deepens the fidelity of these data pools, their value grows, akin to appreciating real estate, transforming data into a line item on the balance sheet as a productive asset rather than a mere expense. Scene 2 shifts to premium domain authority and social proof. Here, the digital presence of a company becomes its most strategic property. A domain's authority, earned through consistent search visibility and trustworthy content, functions as an economic moat. It lowers the cost of customer acquisition by enhancing organic gravity, the natural pull of prospects. Brand mentions, too, ascend from ephemeral social interactions to quantifiable earned media value. When a viral tweet or a reputable blog generates exposure equivalent to a sizable media buy, that moment injects tangible capital into the company's brand equity. What was once dismissed as intangible reputation now appears as direct financial impact. In Scene 3, the role of the strategic architect emerges. The challenge is clear. Translate digital metrics in a language that resonates with the CFO. Here, digital ROI modeling forges a new narrative. Vanity metrics fade into the background as executives demonstrate how growth loops, systems that perpetuate user engagement and expansion, create compounding returns without increasing the cost base. This transformation hastens a critical shift in corporate mindset, repositioning marketing spend from a short-term expenditure to a long-term capital investment, justified by robust, data-backed financial logic. Scene 4 confronts the complexity of digital depreciation. Unlike machinery that degrades with use, digital assets depreciate due to obsolescence, irrelevance, or regulatory pressure. The 2025 Genius Act stands as a sentinel, warning organizations to audit data hygiene and ensure ethical frameworks support compliance and trust. Staying ahead requires proactive asset management, rigorous governance, and adaptation to the shifting landscape of privacy and data law. The narrative concludes with a strategic imperative. Leaders must validate that the intangibles driving their business, data equity, digital authority, and brand social proof, are the most concrete sources of value. In a world where innovation outpaces regulation and technology redefines productivity, those who master the science of valuing the invisible stand poised to lead the new era of digital finance.